guys, welcome back to the Fourth Revolution, where I talk about stocks for your portfolio of the future. Today, I'm be talking about a potential market bubble that is being blown up with tech stocks soaring as retail investors flood into the market. So, I'm going to talk about the potential for a bubble burst, as well as some of the justifications for the valuation stretches we've been seeing within the tech sector.
So tech has been the obvious outperformer since the March lows. And you can see it with the innovation-driven NASDAQ 100 index here, driving over 83% to our highs on September 2nd. But we were excessively overbought at this level. As you can see, both my oscillators are indicating overbought levels. And the RSI was actually the highest it's been since January of 2018 to be exact. And institutional investors decided to pull this market back down. And I think a lot of this valuation surge has to do with retail investors jumping in. There's been tens of millions, of new retail investors opening up new brokerage accounts and putting money into the markets hoping to get rich quick. And I think that they've had a big impact on the upward momentum that our markets have seen. That combined with obviously low interest rates, pushing other investors into riskier assets like equities, as well as these analysts being able to push their price targets to the highest levels ever, as the denominator, right, with interest rates being so low, dropping, you can actually value these companies at higher than they've ever been valued before. But the question is, have we gone past an equitable value? And I think that there are signs that we have, and there are signs that we have seen a bit of a bubble blowing up in our faces. And it's not an irrational one. It's one based off of, huge market optimism in tech. Still, we see a inhibited stock performance from airlines, banks, and other pandemic sufferers, should I say. But institutional investors are still in play, and they pulled the markets back down here the last couple days, jumping off our 50-day moving average. And I'm not convinced that this 2-day push back off this 50-day moving average is going to hold. I think that we are in for potentially a further downfall. It's just a matter of how much further we can fall from here. So there are two sides of this bubble argument. The first one, obviously, is interest rates. Interest rates are the lowest they've been in history, with Jerome Powell and his dovish band of governors keeping interest rates low indefinitely. They're saying that they're going to let inflation ride, which could leave interest rates at zero or close to it for years to come. So what does this mean for the markets? It means that analysts can actually value stocks at a higher valuation than they ever have in the past, considering that the discount rate, which is the denominator in their equation, is the lowest it's ever been, which makes the numerator more valuable the further you go out, especially with these tech companies having massive earnings in the future. They're able to discount that back at a higher rate. So these companies are actually justifiably more valuable today than they were ever in the past. But the question is have we pushed past an equitable level, right? So the NASDAQ 100 has rallied over 83% since the lows in March. And a lot of this has to do with these retail investors flooding in. They don't know anything about fundamentals. They don't know anything about valuation. They're just buying in because they don't want to miss out on any potential earnings. And you saw it with Tesla and Apple, like I was saying earlier. They're both split surges in the past couple of weeks, illustrated that investors don't really understand what valuation means. They buy stocks because they're cheaper. They saw Tesla back down at 400. Oh, it's a buy. In realistic terms, the valuation has never been higher for these companies, and they continue to push further and further up. So this year is going to be the largest year for IPOs as far as capital raised since the dot-com bubble in '99. If this is including Jack Ma's Ant Group's IPO, which is anticipated to raise $30 billion in October. So that is one thing: over optimism in the market, excess in IPOs. That is a topping signal. as well as these special purpose acquisition companies, call them SPACs. They have raised $33 billion for 86 of these SPACs since the beginning of the year. And what the SPAC is a promise to buy another company. It's kind of an ambiguous IPO that doesn't really own anything at the moment, but it's a promise to buy a company in the future. So it's a very speculative, I guess, financial instrument, you could call it. And this is another sign that the investment market could be a little bit in excess right now. So continue watching. I think this pullback could be larger than we've seen, and this potential bull trap that we've seen the last 2 days, with the markets rallying back, could be something that could lead to a further downfall in the future as institutional investors push these stocks towards equitable levels. So thanks for watching, guys. Don't forget to check out Zacks.com/promo, where you see our latest Zacks promotion, and I'll see you guys next time.